Hi, I'm Steve LaFrance with Blakely Financial, and here are some highlights from the previous 3 months. We're entering a new quarter with something of a bounce since Q1 closed with all the major indices in the green. Jobs remain plentiful with openings significantly above pre-pandemic trend. Inflation is easing and consumer spending remains above trend, all while the economy continues to withstand normalized interest rates. I'm intentional about using the word normalize here because a Fed rate near 5% is an excellent target for a healthy economy. And we now have a whole generation who have never experienced rates in this range or slightly higher before. Think about that. Stocks traded higher in January only to give up some of their gains in February and March, with the S&P ending the quarter up 7.4%. Global markets also posted positive returns of 9% and 4.1% for developed and emerging markets respectively. Bonds traded in both directions in anticipation of the end of tightening, then reversing lower as the Fed hinted at higher rates for longer. The failure of Silicon Valley Bank put everyone on edge and raised concerns around financial stability similar to the 2008 crisis. However, banking reforms have since strengthened the overall financial system with higher capital requirements and greater authority for regulators to resolve issues in large failed banks. While banks may be feeling some stress from the rapid interest rate increases, most analysts agree the situation is not systemic. The Fed's Michael Barr made his position clear that SVP is a, quote, textbook case of mismanagement. On the personal finance side, credit card balances are starting to rise at arguably the worst time as interest rates are climbing as high as 20%. In Q4, the average household's credit card balance was $9,900, which was up 9% from the previous year. Part of the problem relates to how people don't see the real cost of their monthly expenses, since most transactions are digital and inflation is causing these balances to creep up. Let's pay attention to that. The near-term outlook remains indecisive, as some investors believe the Fed's actions will slow economic growth and tip the economy into recession. This group points to recent bank failures as a warning that higher rates will have a negative impact. In contrast, some investors believe the economy is strong enough to withstand the Fed's actions. This group points to recent economic data as a sign of strength and banking regulators' actions as an indication the financial system is functioning as intended. This back and forth is likely to continue until some of the market's most pressing questions are answered, such as the direction of Fed interest rate policy, the stability of the banking sector, inflation stickiness, corporate earnings growth, and the strength of the U.S. economy. The current investment environment requires a long-term outlook. Trend changes are frequent, fast, and driven by fluctuating headlines, and keeping up with the day-to-day whims of the market can be emotionally taxing. Developing a plan and sticking to it are important steps to achieving your goals, so please do not hesitate to reach out to our team if you have any questions or concerns about your financial plan or situation.